Welcome to the VectorVest special presentation, this week titled, Take It As It Comes. My name is Todd Shaffer, Manager of Research for VectorVest, and I will be your presenter this evening. Markets rise and markets fall. VectorVest market timing keeps us on the right side of those moves. With red lights gathering in the color guard, our guidance to aggressive traders has been to trade with a bias to the downside. Finding the right trades is easy in the VectorVest system, particularly with the power of the UniSearch tool. Our instrument of choice for tonight is Contra ETFs. Contra ETFs are a perennial favorite of traders since they're bought long, requiring no margin and making them available to trade in our tax-protected accounts. For tonight's conversation, I'm going to make the assumption that you're already familiar with Contra ETFs and the use of exponential moving averages. If you're not, if you need more information on these topics, then please refer to these resources, these other special presentations on November 20th, 2020. Our presentation titled Trading the EMA Squeeze Play will show us the details of the techniques that we're going to highlight today with some moving averages, and also a presentation from June 12th of last year, buying Contra ETFs, because Contra ETFs do behave a little bit differently from stocks. So my brief recap or overview: Contra ETFs are ETFs that are designed to move opposite to their underlying. They often employ leverage, which induces volatility and may have very thin volumes, so we'll check for that. Moving averages provide users an indication of trend direction and acceleration. Particularly traders will use short-term exponential moving averages as they're faster acting. Taking it as it comes means we're going to go with the flow of the market and trade the stocks or ETFs that are moving with the market direction. We've been collecting red lights since the primary wave changed on February 18th. Let's change our color guard gadget and size. And we can see our red light from February 18th with a change in the primary wave to down, and since then we've been adding red lights as the market strengthens to that downside move. And our guidance has been for aggressive traders to play with a bias to the downside. And I'm focusing on aggressive traders because bearish markets tend to move more quickly and have more volatility, so they do require a different approach from a slow and steady rising market. Let's take a look at a market timing graph. And here we're looking at just the price of the VectorVest composite over the last 3 months. That zooms me in enough so you can see some clarity in the candlesticks. When we see the market peaked on our high here on the 16th of February, and if I overlay the primary wave signals, we received our first timing signal change on the 18th of February. Just 2 days off our high, and that being our fastest signal, it's designed to respond quickly. So 2 days off the high with the market broadly falling, our contras should be rising, particularly as our downward move has extended. I would also point out, look how the height of the candles is indicating the broader range of price action, the higher volatility experienced in this downward move. So to illustrate this concept, let's use the UniSearch tool to find Contra ETF candidates on the day of our primary wave change, February 18th. So come over to the UniSearch tool. In the ETFs folder, Contra ETFs have this red arrow because they are bearish, even though we buy them long. And of course, there are several bearish searches within the ETF group. But the Buying Contra ETF search looks for stocks that are in the ETF short industry group, who have a price greater than $1 and have at least 100,000 shares of average volume. This is particularly important because there are a lot of ETFs that have very thin volumes. So you want to make sure that you have liquidity on anything you trade. We want them to be on the major exchanges, and we're excluding Contra ETF. We're going to sort those results VST ascending, so the stocks that have the lowest VST scores will come to the top of the list. And let's look for these candidates on the date of our primary wave change, which, if you don't remember, we can look it up here was 2/18 of 2021. So that changes the date that we're going to run our search, and I'll click Run Search. Let's close our toolbar. And you can see, just looking at the results, these are the stocks from the 18th that we found with their data points from that day. Here we can see the VST sort ascending designation. Because we don't analyze ETFs for their fundamentals, RV and RS are neutral at 1 and 1. That means any VST sort is essentially an RT sort. And when the VST scores are tied, our secondary sort is alphabetical. So with this sort, it's essentially similar to a bottom fishing sort. We're right at the market turn. Remember, 2 days off of the actual market high. So while the market was rising, these Contra ETFs were falling. And so now that we're near the market turn, right at it, we're looking for these Contra ETFs to explode up off of their lows. And we can see that visually if we look at their graphs. I've set the hard right edge of the graph to be our search date, February 18th. And notice as the market's been rising, the general shape of the price action is lower over a year. RT is at depressed levels. And as we flip through the first few of our search returns, notice that pattern, pretty universal across our list of candidates. If I zoom into 3 months, you'll see in the near term, though, some of these ETFs have started to make the turn up off of their lows. Of course, some of them haven't and are continuing to move lower or consolidate at their lows. So let's go back to our search results and let's benchmark the performance of the search result from the 18th to current. So we'll quick test the top 10. And all in all, not a bad result. We ran the change in price from the 18th of February to the 4th of March. The basket as a whole was up 4.17%, while the market, by virtue of the VVC, was down almost 5%. We had 6 winners and 4 losers. What we learned from the squeeze play lesson is that we'd like to see a positive crossover of moving averages sloping higher and fanning out as a signal that it's time to buy. So if we look at the graph of FNGD, I'm going to add 2 moving averages to the price action. So I'll right click, add a moving average, an exponential. We'll just choose 10 for now. We're going to add 2. And I'll change their values to a 3 and an 8. The squeeze play presentation uses a 5 and 13, which is fine. My preference is for the 3 and the 8. Let's add them to the price action. Bringing the hard right edge back to current, let's zoom into 3 months. Price had risen, but the moving averages had not yet crossed positive. The squeeze play method would look for the positive crossover of the moving averages, and they're fanning out, showing us that price is accelerating to the upside, and we should also be seeing a rise in RT. And we see ultimately that developed, but it was 3 or 4 days after our signal date. So if we look at the other ETFs that made gains during that time frame, just looking at their graphs, we can see that that is universally true. They had the bullish crossover of the moving averages with rising RT. SRTY, while it had the crossover, didn't accelerate. The moving averages didn't fan out. And it had much slower acceleration, which now may be picking up the pace a little bit, but certainly underperformed our best performers in this time frame. Also, universally, if we take a look at those that didn't make gains, we never had the crossover of the moving averages. As you may know, the UniSearch tool can help us find these crossovers if you have the Pro Trader tool on your account. And by the way, you can get a free trial with the link that we put in the views tonight if you'd like to explore this concept. But here's what it looks like in the UniSearch tool. If we pull down our search results, we can add a line, stocks, price volume split adjusted, and we have a special operator in the Pro Trader group. And of course, there are many technical indicators here from which to choose. We're going to work with EMAs. And for the value, I can specify the combination of moving averages I want to use. So we'll use a 3-day EMA. If I choose crossed, it'll look for the actual crossover is currently above or below, or has been for a number of days. So I'm going to select is currently, and has been for at least the last day, above the 8-day EMA. And we'll click OK. And now I can run the search. And we found some of the same stocks that our original search found that have that crossover of the moving averages, LABD, SRT1, and TZA. But remember, some of those ETFs, if we zoom into 3 months, and here's the date of our search, some had crossed over but were not fanning out. I can enhance this concept of the moving average crossover to include the fanning concept by using a lesser known cousin to the moving average crossover, the RMA, the relative moving average. An RMA measures the relationship between the moving averages. So in this case, we'll set it to exponential, set it back to our 3 and our 8. And we have several ways to use the information. We can simply display the calculated value of the RMA. We can filter by its absolute value with these operators. Near means we'll be within 5%. And we can also sort ascending and descending those values. So we'll use the sort because there's something to be learned here, and we'll sort in descending order. So what the RMA is doing now is it'll take the value of the 3 EMA and divide it by the 8 EMA and express that relationship with the point value. So imagine if the 3 and the 8 were the same value, then our quotient would be 1. If the 3 is greater than the 8, then the quotient would be above 1. If the 3 is less than the 8, then the quotient would be below 1. So let's click OK and let's rerun our search. And I'm going to minimize the parameter window so that we can see more of the results, because what I want you to notice, we're sorted by the RMA value, descending. So any of these ETFs that have an RMA less than 1, the 3 EMA is below the 8 EMA. Any that are tied, they've not crossed over. The only ETF that we have above 1 is LABD. The value of 1.04 means that the 3 EMA is 4% higher than the 8 EMA. And of course, 1.03 would be 3%, 1.02, 2%, etc. So as price accelerates, the moving averages accelerate and their separation expands. So this is a reflection of how fast that price is accelerating. So to further refine the concept, coming back to our search results, instead of sorting descending where I'm still seeing those that haven't crossed over yet, if I come back and set an absolute value that I need the RMA to be greater than, say, 1.02, in other words, more than 2% separation between the 3 and 8 EMAs, when I rerun the search, I only find LABD, which had an RMA of 1.04. So now it's filtered out those Contra ETFs that haven't crossed over, and in fact haven't crossed over more than 2%. But that one, if we quick test our results, is up 45.5% in that same time frame. So using that technique, I ran a series of tests, advancing one day at a time. So we moved the calendar to the 19th, ran the search, still only found LABD. Let's go to the 22nd. Now it found 3 additional stocks. If I look at their graphs from the 22nd, notice I've had the crossover. I'm getting the separation. RT is accelerating. Crossover, acceleration. Crossover, acceleration. Crossover, and we did pull back, but ultimately acceleration. And by the way, these Contra ETFs, as we stated up front, have higher volatilities and they will move. So you certainly want to have a trading game plan in place, and the EMA squeeze video has some good places for you to start. So to put numbers on that performance, if we quick test them, again from the 22nd to current, the basket up 19.27%, while the market was down 4 3/4. So I ran an A/B test using this methodology of running the base search buying Contra ETFs with daily baskets and compared that to the performance of our modified search running daily baskets. And here are my results. To set up the table, we have the start date. So this is the date we ran the search and the first date from which we ran our quick test. The base performance is the original search as written. And this is the gain represented during that quick test. And this is the number of winners and losers. First thing I'd have you notice is that we did have at least 50% winners across all of the tests, and all of the tests did find 10 candidates. And the average gains, while the market was falling, all nicely positive. So not poor results by any stretch of the imagination. But with our enhancements, I think you'll be pleasantly impressed. Our gains are multiples of what we were getting on the base performance level. Now you do have to remember though, this 45% gain was on one stock. We only found one stock in that search. As time goes by and the trend develops, the search starts finding more stocks overall. But the winning percentage is a compelling argument. Of course, in both cases, we're vastly outperforming the broad market. So bringing our search to the current date, let me pull up their graphs, because remember, we want to look at the slope and the fanning of the moving averages and rising RT. And you can cherry pick from this list the best candidates. You could also sort your results RMA descending to get those that are accelerating the fastest to the top of the list. Now, while the focus of this conversation has been on this bearish market move, of course, this can help with bullish moves too, but we'll do more on that later. So in conclusion, VectorVest market timing keeps us on the right side of the market trend. And finding the right trades is easy with the power of a tool like UniSearch and the VectorVest system of analysis. I honestly don't know of a better tool in the industry. The most powerful tools in the industry designed to help you take it as it comes. Thanks for watching.